High Volume Candles Analysis. Welcome to High Volume Candles Analysis. In this comprehensive guide, we'll explore how to master both day trading and swing trading using volume-based strategies. Get ready to learn the art of volume-based trading and discover how understanding volume can transform your trading results. Why volume matters. Let's start with the fundamentals. Why does volume matter? Simply put, volume is the fuel that drives price movements. Think of it this way. Without volume, price action is just noise. Volume serves 5 critical functions in your trading. First, it confirms trend strength and direction, giving you confidence in your trades. Second, it identifies potential reversals early, often before price shows clear signals. Third, volume reveals institutional buying and selling, letting you follow the smart money. Fourth, it validates breakouts and breakdowns, helping you avoid false signals. And fifth, it shows true market conviction, distinguishing between weak moves and strong ones. Here's the key insight. Volume tells you who is in control of the market at any given moment. What are high volume candles? So what exactly are high volume candles? By definition, these are candles where trading volume significantly exceeds the average, typically by 150 to 300% or more. High volume candles have several key characteristics. They show volume that's 2 to 3 times the average or higher. You'll see a clear visual spike on the volume bars at the bottom of your chart. They're often accompanied by strong price movement in one direction. And importantly, they indicate institutional participation, meaning big money is moving into or out of the stock. How do you recognize them? Simply compare the current volume bar to the 20 to 50 period moving average. If it's substantially higher, you're looking at a high volume candle. Type. Here. There are 4 main types of high volume candles you need to understand. First is the bullish high volume candle. This is a green candle that closes near its high, showing strong buying pressure. It's typically a trend continuation signal in an uptrend. Second is the bearish high volume candle. This is a red candle closing near its low, indicating strong selling pressure and downtrend continuation. Third is climax volume. This shows extreme volume, often 3 to 5 times the average, with long wicks on the candle. This signals exhaustion and serves as a reversal warning signal. Fourth is breakout volume. This occurs when price breaks through key resistance or support levels with strong volume, validating the breakout and suggesting continuation is expected. Volume spike pattern. The volume spike pattern is characterized by a sudden 3 to 5 times increase in volume compared to the average. What does this mean? It typically indicates one of several scenarios. Major news or an announcement is driving activity, institutions are entering or exiting positions, a trend change is beginning, or high volatility is ahead. Your trading action should be to wait for direction confirmation before entering. Once you see which way the momentum is headed, trade with that momentum rather than against it. Volume climax exhaustion. Volume climax, also known as exhaustion, occurs when you see the highest volume in weeks or months combined with a reversal candle pattern. This signals several important things. Trend exhaustion is occurring. There's either panic selling or euphoria buying happening. You're likely at a major reversal point, and smart money is exiting their positions. Your trading action here is to look for counter-trend opportunities, but always wait for confirmation before entering the trade. Volume confirmation. Volume confirmation is one of the most powerful signals in trading. This occurs when rising price is accompanied by rising volume, or falling price is accompanied by falling volume. This pattern indicates a healthy trend with strong participation, giving you high probability of continuation and low reversal risk. Your trading action should be to trade with the trend and consider adding to winning positions as the trend confirms itself. Volume divergence, warning. Astorason. Now let's talk about volume divergence, which is a critical warning signal. This occurs when price makes new highs or new lows, but volume is actually declining. This is a major red flag. It means the trend is showing weakness. There are fewer participants supporting the move, a reversal is likely brewing, and there's a lack of conviction in the current direction. Your trading action should be to tighten your stops, prepare for a potential reversal, and reduce your position size accordingly. Day trading strategy number 1, opening range breakout. Let's dive into our first day trading strategy, the opening range breakout. Here's the setup. Mark the high and low of the first 15 to 30 minutes of trading. Wait for a volume spike of at least 2 times the average. Then watch for price to break out of this range. Your entry is triggered when price breaks above the high or below the low of the opening range, but only with volume confirmation. For your exit strategy, target 1 to 2 times the height of the opening range. Place your stop at the opposite side of the range. Trail your stop with the 5-period exponential moving average as price moves in your favor. Day trading strategy number 2, volume spike reversal. The second day trading strategy is the volume spike reversal. The setup requires an extreme move of 3% or more happening rapidly, a volume spike of 3 to 5 times the average, and then a reversal candle appearing. Enter on the first pullback after the reversal when momentum is decreasing. Place your stop at the swing extreme. For exits, target the VWAP or a major moving average. Scale out of your position at a 1-to-1 risk-reward ratio and trail the remainder of your position. Day trading strategy number 3, VWAP, sur high volume bounce. Strategy number 3 is the VWAP plus high volume bounce. Look for this setup. Price pulls back to VWAP on low volume. A high volume candle appears right at VWAP. The candle closes back above VWAP. Enter when price breaks above the high of that high volume candle. Place your stop just below VWAP. Exit at the previous high or resistance level. Scale out at key levels along the way and trail your stop under pullback lows. Swing trading strategy number 2, breakout confirmation. Swing trading strategy number 2 is breakout confirmation. Look for a multi-week consolidation pattern with price at resistance. When a high-volume breakout occurs, you have your setup. Enter either on the breakout day or on a pullback, but require at least 50% above average volume. Place your stop below the pattern. Exit using a measured move target. Hold through 10 to 15% pullbacks. Exit on climax volume or reversal signals. This works best for growth stocks forming bases. Swing trading strategy number 3, volume support bounce. The third swing trading strategy is the volume support bounce. The setup involves an uptrend that's pulling back, high volume appearing at a support level, and a rejection candle with a long lower wick. Enter on the close of the reversal day or on a break above the prior high. Place your stop below the support level. Exit at the prior swing high. Trail your stop with the 20-day moving average. Exit if support breaks. This strategy works best for trending stocks and market leaders. Key volume indicators. Review the key volume indicators you should be using. First is the volume moving average, typically set to 20 or 50 periods, which provides your baseline for comparison. Second is VWAP, the volume weighted average price, which serves as an institutional benchmark and acts as intraday support and resistance. Third is on-balance volume, or OBV, which tracks cumulative volume flow and helps detect divergences. Fourth is volume profile, which shows you the price levels with the most volume activity. And fifth is relative volume, or RVUL, which compares current volume to average volume for the same time of day. Relative volume, RVUL. Relative volume is calculated by dividing current volume by average volume for the same time of day. Interpretation is straightforward. RVOL of 1.5 to 2.0 shows increased interest. RVOL of 2.0 to 3.0 indicates significant activity, and RVOL of 3.0 or higher signals extreme or unusual activity. This is best used for intraday scanning to find hot stocks. Entry rules, the 4 commandments. Here are the 4 commandments for entries, and there are no exceptions. Commandment 1, volume confirmation. Require minimum 150% of average for day trades, 50% for swing trades. Commandment 2, candle structure. The close must be in the upper 25% for bullish trades or lower 25% for bearish trades. Commandment 3, context check. Align with the higher time frame trend. Commandment 4, proper timing. Wait for the candle to close or for confirmed break. All 4 must align. No exceptions. Exit rules. Protect your profits. Exit rules are just as important as entries. Let's cover profit targets, stop losses, and trailing stops. For profit targets, scale out at predetermined levels using support and resistance zones. Take partials at 1-to-1, 2-to-1, and 3-to-1 risk-reward ratios. For stop losses, place them below structures such as swing highs or lows. Risk a maximum of 1 to 2% per trade. Use ATR for volatility adjustment. For trailing stops, use the 8 or 20 period exponential moving average for active trailing. Lock in profits systematically and never let a winner turn into a loser. Positions, multiple time frame confirmation. Use a multiple time frame framework for confirmation. The higher time frame, typically the daily chart, shows you the big picture trend. Your trading time frame, such as the 1-hour or 4-hour chart, shows you where the opportunity is. The lower time frame, like the 5 or 15-minute chart, gives you the precise entry trigger. Here's an example. Daily uptrend plus 1 hour volume at support plus 5-minute breakout equals a buy signal. Namanumam, sursidinam. Risk management rules. Risk management operates on two levels, portfolio and trade. At the portfolio level, risk a maximum of 6% of your total portfolio. Keep maximum 2% in correlated positions. Reduce size after losses, and increase cautiously after wins. At the trade level, risk 1 to 2% per trade maximum. Remember, wider stops mean fewer shares. Always know your risk before entry. And don't forget emotional capital. Take breaks after 2 to 3 losses in a row. Common mistake number 1, ignoring volume. The first common mistake is ignoring volume. The error is trading price patterns without volume confirmation. Why does it fail? Price without volume equals no conviction, which equals false signals. The fix is simple. Always check the volume histogram. Make it your first filter. And remember, no volume means no trade. Common mistake number 2, chasing volume spikes. Common mistake number 2 is chasing volume spikes. The error is entering after a huge candle has already moved 5% or more. Why does it fail? Late entry equals poor risk reward, which equals getting trapped. The fix, wait for the pullback. Let the trade come to you. Patience pays. Common mistake number 3, false breakout traps. The third common mistake is falling for false breakout traps. The error is trading breakouts with weak volume. Why does it fail? Low volume breakouts fail 70% or more of the time. The fix require at least 2 times volume minimum. Watch for follow-through and be willing to skip marginal setups. Common mistake number 4, ignoring context. Common mistake number 4 is ignoring context. The error is taking every high volume candle as a signal, regardless of where it appears. Why does it fail? Location matters. The same pattern can have different outcomes in different contexts. The fix, check support and resistance levels. Verify the trend direction. Consider overall market conditions. Remember, context is everything. Common mistake number 5, wrong time frame analysis. The 5th common mistake is using the wrong time frame for analysis. The error is day trading based on weekly patterns or swing trading based on 5-minute charts. Why does it fail? Time frame mismatch creates conflicting signals and confusion. The fix, match your analysis to your trading style. For day trading, use intraday volume. For swing trading, use daily or weekly volume. Stay consistent. Practical, the volume checklist. Before every trade, use this checklist to verify your setup. Is volume 150% or more of average for day trades, or 50% or more for swing trades? Is the candle structure clean with a strong close? Does the context align with trend, support and resistance, and market conditions? Does the higher time frame confirm? Is your risk limited to 1 to 2% maximum? Is your exit plan clear? Have all 4 entry rules been met? If any box is unchecked, skip the trade. Volume never lies. Here's a fundamental truth to remember. Volume is truth. It shows what's really happening in the market. Price is opinion. It shows what people think. Trade the truth, not the opinion. When volume and price align, you have high probability setups. When they diverge, you have warning signals. It's that simple. Building your edge. Let's talk about building your edge through deliberate practice. Week 1 to 2, observe. Study charts and identify patterns daily. Week 3 to 4, backtest. Test strategies on historical data to see what works. Week 5 to 8, paper trade. Practice with simulated money until you're consistent. Week 9 and beyond, go live. Start small and scale gradually. And always keep a journal. Review every trade and learn continuously. Success principles. Success in trading requires 5 key principles. 1, discipline. Follow your rules 100% of the time. 2, patience. Wait for A+ setups only. 3, consistency. Trade the same way every time. 4, adaptability. Adjust to changing market conditions when needed. 5, persistence. Stay committed through challenges and setbacks. Your action plan. Here's your action plan to get started. This week, review 20 charts for high volume patterns. Identify 3 potential setups. Paper trade these setups. This month, master one strategy completely before moving to others. Build your watch list process. Achieve consistency in paper trading. This quarter, go live with small position sizes. Scale up as your confidence builds. Refine and optimize your edge continuously. Key takeaways. Let's review the key takeaways from this presentation. Volume confirms price movements and separates real moves from noise. High volume equals high conviction from market participants. Always check context and candle structure before entering. Risk management is non-negotiable for long-term success. And remember, consistency beats complexity every time. The market rewards those who respect volume signals and manage risk intelligently. Final words. Here are my final words. Volume is the X-ray of the market. It reveals who's in control, whether bulls or bears. It shows whether moves are real or fake. It tells you when trends are starting or ending. And it reveals where the smart money is positioned. Master volume analysis and you'll see what others miss. You'll have a genuine edge in the markets. Thank you. Thank you for your attention and commitment to learning. If you have questions, don't hesitate to review this material again. Remember these key points. Start small. Be patient. Stay disciplined. Keep learning. Your trading journey starts now. Make it count. Resources and next steps. Finally, let's talk about resources and next steps. Practice daily by reviewing volume patterns on your watch list. Keep a trading journal with screenshots of your trades. Study both your winning and losing trades to understand what works. Continue learning by reading Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. Study institutional volume patterns. Join trading communities for support and shared learning. Recommended tools include TradingView, Thinkorswim, and TrendSpider. Start today. The best time to begin was yesterday. The second best time is now. End of presentation.